Welcome back. So we've talked about financial assets, we've talked about financial liability, and we've also talked about equity. Now, one important thing that we need to talk about is the disparity between equity and liabilities. When a company issues shares as a result of a purchase from an investor, the popular view is always that the issue of shares should always go into equity. But this is not always the case, and it is even very crucial to be able to identify the difference between equity and liabilities because of various reasons that we'll be looking at shortly. All right, so to get started, I would like you to try this question here and see if you are able to answer it. So the question is about whether this scenario should qualify for debt or equity. So you can answer it now, or you can come back to it later after you've gone through this section. So the question is that the issue of shares by the company to the investor, should it be accounted for as debt, that is financial liability, or as equity? Okay, so distinguishing equity from liabilities. Distinguishing equity from liabilities is very important, and we'll see some of the reasons why we view it as very, very pivotal in terms of how to account for them. So one of the major reasons is that distinguishing them affects an entity's gearing ratio. Gearing ratio looks at the ratio between the debt of a company and the equity of the company. And you know that the more debt a company takes on, the higher the interest that will be paid by the company in order to finance that debt. Another area that is of concern is with respect to dividends to be deducted directly from retained earnings. So the higher the equity, the higher the number or amount of dividends to be deducted, while the higher the debt, the higher the interest rate. And it also has tax implications as well. Now, investors' negative perception of equity is also a big deal, because if you issue out shares and you classify it as equity, there's a high chance that the incoming equity will dilute the existing equity. And so there are a lot of plus and minus that comes in play when a company issues shares. It's always of importance to investors to check whether the shares that is being issued is being recognized as equity or liability, and the recognition is dependent on the terms of the agreement. I'll be looking at quite a number of them in this section, just to be able to identify the key pointers to being able to differentiate between what should be appropriately classified as liability or what should be appropriately classified as equity. And you know that liability requires an outflow of resources at some point in the future. But when it comes to equity, it is an owner's interest. There is no repayment obligation. And so, in fact, when it comes to the bankruptcy and liquidation of a company, equity takes last. And so it is very important to be able to accurately and appropriately identify whether the shares that you have issued qualifies for equity or qualifies for liability. We'll see all those criteria shortly.